Right now, Cisco Systems, traded under the ticker CSCO, is at $77.36. That is a significant move, up $3.40 or 4.59% on the day. This isn't a quiet drift. This is an explosion in price, and it's happening on massive volume. The stock gapped up at the open and has been fighting all day to hold these gains, even pressing on to set a new 52-week high of $78.10 earlier in the session. For a company of this size, a nearly 5% jump is a major event, and it's not happening in a vacuum. This is the market's direct, visceral reaction to the fiscal first quarter 2026 earnings report that dropped late last night, and the numbers have completely scrambled the market's perception of this company. The immediate surface-level expectation for Cisco, the one that's been baked in for years, is that of a boring tech utility. It's the safe old tech name you buy for the dividend, a staple of Fidelity mutual funds, or perhaps a core holding in a Schwab Intelligent Portfolios account designed for stability. The expectation was for a decent, inline quarter. The reality, as revealed by last night's numbers, is that a new high-octane growth engine is firing up under the hood, and it has everything to do with artificial intelligence. The market believed it understood Cisco. It's the plumbing of the internet, the routers, the switches, the hardware that makes everything connect. In a world obsessed with high-flying names like NVIDIA stock or the ecosystem of Apple stock, Cisco was seen as the reliable, slow-moving workhorse. That entire narrative just got challenged. The company didn't just meet expectations, it delivered a double beat, with $14.9 billion in revenue versus the $14.78 billion consensus, and earnings per share of $1, topping the 98 cents analysts were looking for. But those numbers aren't even the real story. The real story, the reason the stock is flying, is the guidance and the source of the strength. CEO Chuck Robbins stated in no uncertain terms that demand for AI infrastructure is accelerating. Cisco reported a staggering $1.3 billion in AI infrastructure orders just in this past quarter from hyperscale cloud providers. This wasn't a forecast or a vague promise, it was a hard number. On top of that, the company raised its full-year revenue forecast for fiscal 2026 to a range of $60.2 billion to $61 billion. The market was only expecting $59.7 billion. This shift in guidance is the catalyst. It suggests that the AI-driven, multi-year growth cycle that analysts were hoping for might actually be starting right now. This move is forcing a total re-evaluation. Investors who have been doing their self-investing and watching Cisco sit relatively flat for ages are now seeing it behave like a growth stock. The action on the Fidelity trading platform and among Interactive Brokers clients today is likely frantic. You have long-term holders, many through Fidelity IRAs, who are suddenly sitting on a massive gain and wondering if this is the new normal. Simultaneously, you have momentum traders, many using the Robinhood app or SoFi Invest account, piling in, chasing the breakout to a new 52-week high. The trading volume is confirming this. We're seeing institutional-sized blocks being moved. This isn't just retail enthusiasm. This is a fundamental repricing of the stock by the big players. Analysts are scrambling to catch up. Rosenblatt just jacked its price target to $100. Melius Research followed, also raising its target to $100. UBS reiterated its buy rating, seeing a path to $88. The consensus is that the market fundamentally misunderstood Cisco's position in the AI build-out. While NVIDIA stock provides the high-powered brains, GPUs, Cisco is providing the advanced high-speed nervous system, the networking gear required to connect tens of thousands of those chips. This is the new bull case. However, we have to apply the expectation versus reality framework to the entire report, not just the good parts. The market is euphoric today, but if you look closer at the earnings data, there is a glaring, bright red warning sign that the bulls are conveniently ignoring. While the networking and AI segments were fantastic, Cisco's security segment was a profound disappointment. Revenue for that division actually declined by 2% year over year, coming in at $1.98 billion. This wasn't just a miss, it was a significant miss against the $2.16 billion Wall Street was expecting. This is a critical issue because Cisco has spent years and tens of billions of dollars telling investors that security was its next great growth driver. This weakness is especially concerning given Cisco's massive $28 billion acquisition of Splunk, a deal that was meant to cement its leadership in security and observability. To see the core security business falter right as the Splunk integration is getting underway is a major problem. It raises the terrifying question, is the AI boom just masking a deep, fundamental weakness in one of the company's other core pillars? This is where the real tension lies. The market expects the AI growth to continue. The reality is that the company is now a tale of two very different businesses. On one hand, you have the networking division, which is riding the massive AI tailwind and seeing its fifth consecutive quarter of double-digit order growth. This is the growth engine that has traders on Robinhood stock trading platforms excited. On the other, you have a struggling security division that just missed estimates badly despite a $28 billion bet on Splunk. This is the part that should have long-term investors using Fidelity Wealth Management Services asking tough questions. The market is paying for the AI story today, but it's getting the security problem for free. The entire narrative of Cisco as a holistic end-to-end provider of secure, intelligent networking is challenged if one of those components is actively shrinking. This is the kind of detail that separates professional analysis from public hype. It's the kind of thing traders using the advanced tools on Interactive Brokers are digging into, weighing the options pricing against this internal conflict. For those who are newer to the name, let's briefly establish what Cisco Systems actually does, because it's more than just the desk phones and WebEx rooms you might remember. Cisco is a foundational technology company. Its business is broadly broken down into a few key areas. The largest and the one getting all the attention today is Secure Agile Networks. This includes its core campus and data center switches, enterprise routing, and wireless hardware. This is the plumbing that is now being supercharged by AI. Then there's the Internet for the Future segment, which includes optical systems and silicon. But the other two big pillars are collaboration, WebEx, and the aforementioned security, firewalls, endpoint security, and now Splunk's observability platform. The entire bull thesis, the one that Fidelity brokerage account holders have been sold for a decade, is that Cisco will use its dominance in networking to cross-sell all these other services, creating an unbreachable, subscription-heavy ecosystem. The $28 billion purchase of Splunk was the exclamation point on this strategy. The fact that the security segment is failing right now throws that entire strategy into question. This leads to the most important question for the future of the stock. I want you to comment below with your take. Do you think the massive $28 billion Splunk acquisition will ultimately be a success for Cisco, or was it a desperate, overpriced move to buy growth? Looking forward, we are at a genuine turning point for the stock. The path from here is no longer the slow, steady grind investors had become accustomed to. There are now two very distinct scenarios. The bull case, the one that has the stock at $77 today, is that the AI tailwind is so powerful, it doesn't just lift the networking boat, it lifts the entire Cisco armada. In this world, the $1.3 billion in AI orders is just the first drop in a tidal wave. The demand for NVIDIA stock GPUs will create a parallel, non-stop demand for Cisco's highest margin networking gear for the next 3 to 5 years. In this world, the security segment's weakness is a temporary hiccup, a post-acquisition stumble that will be corrected as Splunk's platform is integrated and sold into Cisco's massive existing customer base. If this is true, the analyst targets of $100 are too conservative. This stock will challenge its all-time high from the dot-com bubble back in March 2000. It will be re-rated from a value name to a true growth at a reasonable price story.